Hello and welcome to CoinDesk Research's webinar series. What you're about to listen to is a recording of the second in our series. The first webinar gave us an inside look at the tactics of traders on OTC desks. You can find a recording of it on CoinDesk's YouTube channel. The second goes under the hood with two high-growth crypto exchanges, examining what brings in liquidity. My name's Galen Moore, and in this webinar I'm talking with Catherine Coley, CEO of BAM Trading, known to most of you as Binance US. My other guest is Sam Bankman-Fried, the CEO and co-founder of Alameda Research, a quantitative crypto trading firm. Earlier this year, Alameda opened FTX, a crypto derivatives exchange known for long-tail markets and indices. If you're interested in hearing the next one of these, sign up at coindesk.com/research. Now, let's go right into my conversation with Binance US and FTX. I should mention that the opinions expressed in this recording are not necessarily shared by CoinDesk or its affiliate companies. And none of the content of this recording should be taken by anybody as investment advice.
Hi there, guys. Catherine Coley here, CEO of Binance US. And Binance US, we've launched in late September, and we are a US-based digital asset marketplace committed to really a user-centric platform, trying to bring in a kind of new brand of users, making crypto accessible to everyone. So our focus is on diversity of assets that we list, as well as advancing product and education for people to really understand how crypto can offer freedom for your own opportunities.
Cool. My name is Sam Bankman-Fried. I'm the CEO of Alameda Research and FTX. Alameda Research, which I started a couple of years ago, is a quantitative cryptocurrency trading firm. Just basically a combination of arbitrage, liquidity providing, quantitative trading, and OTC trading across a bunch of different platforms worldwide, including Binance US. Then earlier this year in the spring, I started up FTX, which is a cryptocurrency derivatives exchange, basically aiming to bring sort of a refreshed look at derivatives trading, cleaning out a lot of the baggage that current venues had, and presenting a ton of liquidity, a ton of different products, both in terms of underlying sort of futures and more innovative products like move contracts and leverage tokens, and sort of a completely rethought margin and leverage system.
Great. Okay. So lots to talk about here. I think, my goal is for today, we can talk about some of the liquidity issues affecting crypto markets. We can talk about how liquidity gets built, how it gets sort of acquired, if you will, by an exchange. And also, look into kind of how traders should approach different environments and venues that they might be trading in. So, with that in mind, I think that, the top line number for everybody when it comes to looking at exchanges and trading venues in crypto is volume. And whether that's the right number to be looking at or not, we can talk about it in a minute. But I think, to start with, maybe if we can talk a little bit about both of you in terms of your goals for volume for your exchanges. And I've got a chart up here in the webinar showing the reported volume from Binance US over the month of October. I think on the FTX's side, you guys for October averaged about 177 million in notional volume, at least if what I'm getting from from Nomics is the right data there. So want to know kind of how that, where your goals look in terms of growing that number.
Sure. I mean, to get things started, we started off in September being able to license the technology of Binance.com, which at the time was kind of going through a daily volume around a billion about. So to start off at zero, it was quite a humbling experience. We saw a kind of a keen pickup in our first month, going from zero to about our top day was about 29 million daily trading volume. And a lot of this is, given part to the overall sentiment of the market that you have to factor in. There's so many variables when we're considering, why people are trading on a specific exchange. It can be all the efforts that you do individually or as your team to build out a product that sees fit for the market, but truly a lot of Sam will attest to this, given volume on a great day is to the volatility of the markets. So people are more likely or more inclined to be trading on days where there are outsized volatility in the markets, and therefore needing access into and out of certain coins on a more routine basis than just an average day of buying and hodling. So we saw that kind of as our peak date. And then coming in from the rest of November, we continue to see our user numbers increase and our volume numbers continue to kind of grow in line with where we see the market activity actually happening.
Got it. If you look at Binance, for example, I think average volume the past 30 days is a little north of $1 billion. Is that an aspiration? Are you looking at hundreds of millions and billions in terms of volume and where you'd like to be, say, over some time period in the future? Obviously, you guys are right out of the gate here, so I think
yeah.
By that yard.
No, I always found it quite humbling when I came from the world of FX or foreign exchange, and so our daily trading volume was around like $5 to $6 trillion. So anytime when I see someone's yardstick out there, it's like even $1 billion, I'm like, oh, how little we are in the scheme of things. So certainly in the aspects and aspirations of becoming a 1,000-plus-year-old market liquidity of reaching the same levels as FX, I've got my job set out for the next century. But the aspirations are, I just want to get as many people familiar with cryptocurrencies, understanding how it works, preparing them for a future, and I definitely think that's in our sights.
Sam, what are your thoughts on that, on the volume number and where you want it to go for FTX, where you've come so far?
Yeah. So, I guess first comment, I think the number you say, I think that's the right ballpark. I think our volume's a little higher than that, and typically what you'll see is that our volume's a little higher than most sites report because we have a set of products that are a little bit hard to parse. For most of these sites, we have index futures, for instance, and that means they're not on a single coin that the site has access to, so those usually get dropped. And then we have some volatility products we recently launched, but that's our right order of magnitude, a few hundred million a day. And I think that, as sort of Chloe said, if you look at our raw volume numbers, you'll get something extremely volatile with our biggest day, we got a little over $1 billion traded. And on, an extremely quiet day, I think once a month we might be under $100 million traded.
Yeah.
So, there's a factor of 10 there. But if you instead look at, our volume divided by the volume of, global crypto volume or sort of leading exchanges or something, that you get a much smoother curve. Mm-hmm. And that's sort of how I think about it, rather than sort of raw volume traded. I tend to think of this like fractions of BitMEX's volume, fractions of Binance's volume, things like that. And I think our aspirations, I would say, sort of medium term, and obviously, long term, anything can happen. We have a lot of plans, and some of it's going to be playing it by ear. But I would say, medium term, really, the goal here is to reach the levels of the top exchanges. And so, in environments like this, that generally means a few billion a day. Somewhere between 1 and 10, depending on sort of market environments. And so I think that, if you want to say where do we want to be a year from now, I think the answer is, trading some number of single-digit billions of dollars per day, adjusted for whatever happens to the market, or maybe phrase even better, something like one of the top 3 exchanges by global volume.
What else besides volume, Sam? What I think of that as being a kind of a high level in a way. What other metrics are you looking at as KPI?
Yeah, so I think that volume is what we see as sort of the ultimate thing that matters, but that's not something we have control over. That's sort of something that reflects everything else we do. And so, that's what we ultimately evaluate ourselves on. But the things that we can actually affect are more like liquidity, customers onboarded, both in terms of, number of customers, but also size of customers and things like that, products launched and success of the product. And so, I think for us, I would sort of divide this into 2 different categories. The first, and I think a huge one here, is liquidity, which there are a lot of different ways to define it. But I think price someone would pay if they bought 200 Bitcoins and then immediately sold 200 Bitcoins is that's sort of a decent approximation of what does liquidity mean. And then sort of extending that to the other markets, adjusting for the overall liquidity of the coins. And on that, I think we're doing quite well. I think basically from the day we launched, we were, roughly the most liquid order books in crypto. But in terms of diversity of products, we've been growing pretty quickly. We have futures on something like 20 different underlyings, including, the top coins, index futures, and now we have some options contracts as well. And so I think in terms of product space, I have a lot of aspirations, but I also, to be frank, feel like pretty confident in them. I'd be surprised if we failed to reach those. And that's been just pretty steady progress of releasing new things. And I think that sort of, if you look at where is sort of the huge uncertainty, what's going to determine whether we get to that, $3 billion a day volume or plateau at 300 million, I think the big thing is customers. I think the big thing is, can we get to the point where, 50% of all cryptocurrency traders have an FTX account? And, it's just sort of assumed like, oh yeah, you're trading crypto, like probably FTX is one of the exchanges you're on. Or do we sort of plateau where, it's something more like 10 to 15%? And, there's a sizable slice of people who do, but the majority have never created an account, never started trading, never deposited anything. And I think that that's sort of what we really see as the thing that that's going to end up determining, how big we grow.
Catherine, when you think about like who your user is, what's the kind of person that you have in mind, or person or company or entity who's the sort of typical user of Binance US?
Yeah, that's a great question, because I love how we've tried to kind of boil it down to one type of person, when in reality the target market out there is segmented into fractions that we're all trying to go after. So the products that we provide, have to cater both to the first-time user as well as the advanced trader using APIs. So kind of in our suite of understanding, we want to be able to offer the opportunity for people to engage as best they feel fit, without being kind of the gatekeeper that says this is what you really should be buying. Because I feel like that kind of goes against the purpose of where cryptocurrency lowers those barriers to entry and lets people really access, manage, and grow their own capital from their own determination. So our target audience, clearly the kind of crypto native already, the set that's already bought into the vision, understanding how the trading works. We kind of see them as first adopters having a familiar enjoyment of Binance platform itself. So you'll notice that Binance.us is rather similar in terms of feel, scope, order book, visuals. The APIs are, a familiar sense. And so we kind of can cater towards the crypto aware. And then as well, kind of the more larger focus of mine is making sure both our narrative and our platform are digestible for that new wave of crypto savvy folks. So they may not even recognize what crypto can provide for them, but being able to access funds, send them on the go, really be able to explore different projects and have that autonomy all within their fingertips is something that I think is super important for people as we increasingly have a kind of a global mindset and are expanding through, a variation of careers that people may not have had previously. So if you imagine, like, long are the days of the 30-year career, and now you've welcomed in the gig economy as well as, global projects where you're traveling quite a lot. The idea of having crypto in your portfolio really has its benefits.
I just got a question in from a listener wondering kind of how crypto trading fees compare to other asset categories. And I think that's a good one for you, Catherine, having come over from FX. How do you think about that in terms of fees as an important sort of driver of, bringing people on board as a differentiator? And then also kind of, how do you think the person coming from, being familiar with trading different category of assets would react to the fees that they're seeing on most crypto trading venues?
Yeah, it's kind of funny. I mean, I blame and credit my experience on the FX desk for making me realize that some of the largest money movers out there pay nothing in order to get prices on certain pairs and moving currencies. Whereas myself, when I was on the desk, moving Hong Kong dollars into dollars for, say, Christmas gifts or holiday vacations, required about an 8% fee to a competitor bank on a pegged currency, which to me was, at a principle that was difficult to digest. I was getting, maybe like 1 pip or zero even flat for some, $100 million moves of currencies, and then me sending $35 cost me $35 and then 8%. So the kind of the fee element of how FX and currency has worked is it's been a different model than you see with equities and commissions. And I think that's a tricky one because people oftentimes get, caught up in that as a barrier for them to then engage. And you go, okay, well, if I'm going to be getting into cryptocurrency, but it's going to cost me a percentage or plus in order to get in this position, maybe it's not as accessible as I want it to be, or I'm not planning on holding it for that long. If I have to pay twice if I'm going to get in the trade and out of the trade. So barrier to entry is the main focus that I've kind of been hounding on, and so lowering those fees was really important to our U.S. team to be able to provide for kind of an affordable way for people to learn about the technology. So we provide the first 30 days of your trading when you sign up with Binance US is free trading. So there are no trading fees on top of that. After those 30 days, your initial layer for trading fees starts at 10 basis points or 0.1% of your trading volume. And then if you hold BNB, you get a 25% discount on that. So assuming
Catherine, I'm losing you a little bit on the audio here. You hear me?
Oh, oops, sorry, guys. I hear you guys.
Yeah, that's all right. Just go back to the last
Sorry.
little bit.
Sorry, where did I lose you? No, back to kind of our trading fee structure. So we've rolled out VIP tiers, which give you a rewarded fee structure based on the volume that you're trading. So the more you're trading, the less you have to pay, as well as if you're holding BNB, you get a 25% discount on trading. And these are just in the element of understanding these markets. We don't want to penalize people for learning and experimenting how these things trade. So getting familiar with how, ETH settles and Bitcoin settles, like understanding just the mechanics of it. We want you to be able to explore and really get comfortable with this new technology rather than feel like you're being penalized each way.
Sam, do you think fees are a motivating factor for people on FTX? Is that something you look at as a differentiator and a way to bring people in?
Yeah, no, absolutely. And sort of to echo something that Chloe said, and it's definitely true that, trying to convert FX at your local bank can be a really painful procedure where you're paying percents. But the flip side of this, which I do think is worth saying, is that crypto exchange fees are massive compared to traditional exchange fees. And I think on Wall Street, if you're charged, I think like a tenth of a basis point is sort of a typical fee for a trade. It's phrased differently, like it's a fixed number of fractions of a penny per trade, but generally a tenth of a basis point is sort of like about what you end up with, which is a good factor of 50 or 100 or so lower than crypto exchange fees. So and a lot of that just reflects sort of a combination of the newer industry, a lot of infrastructural and technological barriers that exchanges need to get over, and the volatility of the asset class. But
you've got this weird industry in which exchanges use data as a marketing tool and make their incredible revenue numbers on fees, right?
Yeah, exactly. And one other thing worth knowing, which just flows from this, is in crypto, what are the biggest institutions, the most powerful institutions, the most famous ones? You list off 10 of them, you probably listed 7 exchanges. and if you, maybe, I mean, I don't know, maybe you put like consensus. It's not even clear what you put for the biggest coins, but you basically.
The only business is making any money in crypto, right? I mean, maybe maybe some investors, but exchanges are really sort of the big financial.
Yeah, that's right. Whereas you go to like Wall Street and if you just go to a random trader on Wall Street and say, hey, name like the 10 highest profile businesses on Wall Street, maybe you get one or two exchanges, but no, they're like Goldman Sachs. Maybe they name some trading firms, some quant firms, a lot of banks, and maybe you get NYSE in there.
Yeah. That's so. But do you think that changes over time? Like, I mean, do you think A, fees come down, and B, like we start to think about hopefully we start to think about other entities as being the real giants of the industry?
And so my guess there, it's a good question, and I think that there's a few things going on here. One big thing is volume. Crypto volume is still tiny, as Chloe said, compared to, FX or equity or futures or commodity volume. And so I think, if you do see a jump from, 20 billion a day to 20 trillion a day traded in the crypto sphere, I would expect that you'd see, a factor of 10 or 100 decrease in fees associated with that. And a lot of that, everything just scales, if exchanges are doing 100 times the volume, but their costs have only gone up by a factor of 2, then you're going to see fees competed down.
So I want to ask about another thing and move on from fees and ask about leverage. I just put a slide here, which is something that the folks at Skew.com provided, showing a drop in the volume of the Bitfire perpetual swap back in May, when the regulator in Japan required them to reduce leverage from, I think it was 15x down to 4x, maybe it was. Yeah, so I mean, I think it's just one data point for sure, but kind of shows the importance of leverage, at least in the derivatives markets. And I know Binance has rolled out the trading on margin and the the 125x leverage. I think a couple questions come up there. One is like for both of you, how important is leverage? Maybe something, I think in Binance US, not something you offer now, but maybe something you look to in the future. And also, to what extent are people really actually using the numbers that you see available on exchanges like BitMEX or FTX or the Binance futures, the Binance derivatives markets?
Yeah, and I guess I'll go first here and say leverage is really, really important. And there are a lot of ways to look at this. One is you can just look at volumes, right? Like ranking exchanges by volumes, actual volume. This is not like, CoinNeal being number one over bullshit, CoinMarketCap has these days. And what you see is basically like.
What did you say? CoinNeal?
Yeah, for a while that was number one. It was, and you just look at this site and you're like, no, that's not a real site. Like, I'm sorry, but I've literally never heard of it. It's a % wide, like every single.
You have adjusted volume figures that exclude some of the largest markets in. Right.
And so, CoinMarketCap for a while has really struggled to get real volumes right, to be able to capture the biggest real volumes without getting a ton of crap. But if you like sort of real volume, if you go to ftx.com/volume-monitor, you'll see something which is pretty close to it. And I'm not saying it's perfect, but it basically gets you the highest real volume exchanges. And 75% of the top exchanges are derivatives or leverage exchanges. And it's just Binance is there's basically only 3 spot exchanges in the world that trade big volume. It's Binance, OKX, and Fobi. And outside of that, I mean, almost all the trading's on leverage. And there are a lot of reasons for that. I'll sort of give one, which is that, especially like in traditional finance, there's this notion of sort of global or at least national netting out of positions. Like, you're not like, oh shit, like I'm long so much Apple on NYSE, I'm short so much on Amex right now, like I'm, am I going to get liquidated on this position? No, you're just flat Apple. And, they all settle to the same thing. Any broker worth their salt is going to net out all the major U.S. exchanges and just, give you sort of default cross margin, essentially. And then you look at crypto where an unlevered Bitcoin position on Coinbase and one on Bitstamp are not the same thing. Like there doesn't exist an institution in crypto basically that lets you consider those the same thing for hedging or delta or risk or capital purposes. And so because of that, you have to separately keep collateral on every single platform you're trading. You want to be ready to buy a Bitcoin on Binance US. You have dollars there.
Yeah.
And because of that, it's just so capital inefficient that anything you can do to get more capital efficient is just really crucial.
So it sounds like from what you're saying, Sam, like it matters more for the institutional investor in a way than it does for the generic gambler. I mean,
I think that's
fair.
Yeah, that's absolutely right.
Well, let me, Catherine, I want to hear from you on this because, like, I know this probably isn't something that's in your, horizons for Q1 2020 or anything, but how do you think about leverage and whether it's important and whether it might be something for you guys down the road?
Yeah, I mean, it's certainly been something where kind of an overnight success with Binance Futures. Aaron Gong from the CME has built that out, and it's been kind of a tremendous product for Binance.com. Something that we can clearly see that the market appetite, much like seeing the growth of FTX, being a part of seeing their story, there's an appetite clearly for that product in the market. And it's really interesting from my side to see and blame, we won't blame anything, but it's interesting the perspective, because I always see that we would need leverage products, or in that essence, a hedgeable product for these markets to be digestible for our larger participants. Right. And that's from more of a conservative side of how you're seeing your use of a product like this, or a derivatives expansion in the market. And that's because that goes down to the line of like, well, it makes the markets more practical, and you can hold balances in these currencies while protecting your exposure. But we're not there yet. So, I think it's good for us to build out this robust activity in futures and derivatives to get people familiar with how these markets will be trading, and scale them up to a size that would welcome institutional adoption for a hedge or a corporate use case. But that still is kind of, as you said, not in my Q1.
Your excuse me, Sam, of to what extent people utilize the maximum leverage available on some of the derivatives markets?
So basically what you'll see is you get a huge difference depending on whether you're looking at what fraction of traders do or what fraction of volume does. Mm-hmm. In general, you see a ton of people use maximum or at least high leverage, let's say, but the bigger the position is, the less likely it is to be on high leverage. Yeah. And so, the highest volume firms, and as an example, like Alameda, it's not going to put on a 100x leverage position, especially not a large one, because it's probably going to get liquidated. Because that's just what happens when you put on a 100x leverage position. And if you're trying to do arbitrage, it's not good if one leg gets liquidated. So, when you look at sort of the highest volume firms, you tend to see leverage more in the and I'll say for Alameda, you're looking at more like the sort of 3x is the sort of number that you might see. Whereas, when you look at retail, especially for an unhedged position, there you're a lot more likely to see, 20x, 50x, 100x, something like that. So that's the first thing that I'll see. Say, another thing obviously is if you're getting in and out of positions quickly, it makes more sense to use higher leverage because the amount of time you're exposing yourself to liquidation risk is lower. Whereas if you're planning to put on a position and hold it, and maybe this is a net position or maybe it's a spread against another exchange, but if you're planning to put a position on and hold it for a week on 100x leverage, you're going to get liquidated. Right.
Well, let me move on from this a little bit and get into the many assets that both of your exchanges list. I mean, I guess it's not that many compared to some, but I look at some of, for example, if you look at let's see if I can pull it up here. The assets listed on Binance US. I think you guys, Catherine, you might have told me this over the phone yesterday. You guys went from about 7 when you launched, and over the 45 days or some odd 60 days since then, you're now up to about 24. And I'm just looking at this volume chart here. This is a snapshot. So, it doesn't necessarily reflect what's going on on a more consistent basis, but I think it's pretty clear that there's a very long tail. And I think if we kind of move forward to the FTX picture here, it's pretty much the same thing. There's Bitcoin, and then there's Ethereum, and then there's everything else. And on Binance, it's kind of Bitcoin and XRP, and then everything else. Mm-hmm. So just wondering kind of how you guys think about adding some of these long tail coins, and whether those assets are moving the needle and making a difference for bringing traders and market makers onto your platform.
Yeah, I mean, that's something that we certainly think about. It's been a feature that we've kind of accented or focused on, this diversity of selection that we're going to be providing. And it's been an element that's important to me and our team. And I think the ethos of Finance and CZ's vision as well, along the lines of being able to be a platform that allows for freedom of choice. And so not everyone's first step into cryptocurrency may be through Bitcoin. And so being able to provide a platform that lets people get comfortable with how they see this future working for themselves is something that we want to be, agnostic to. And so provide that may include kind of a tail. Risk might also just be that this is the first time the asset is having access to U.S. users, and we only facilitate operations in 37 states. So perhaps those users are isolated to some of the 13 states that we're not allowed to operate in just yet until we get licenses for those. So we continue to keep the doors.
Dogecoin before, in other words,
yeah, and we can continue to keep the doors open on those coins because they've had vibrant communities elsewhere, or high demand within the United States, and pass through our digital asset risk assessment framework. So
any shade on Dogecoin, by the way.
Yeah. No, it's funny. We people got a lot of mixed reactions on that, but from my standpoint, it's an access point. I'm not here to be the gatekeeper to tell you what you should buy, because I think that's not the position that exchanges should be in. That would be the position that you would be in if you were a protocol.
There's got to be a criteria, right? There's a 2,000 some odd or more. I don't know.
Oh yeah. So we first, when we launched, we listed 7, as I mentioned, kind of what I call large cap coins, and then we've announced that we had 30 coins that we were exploring, and have taken all of those through our digital asset risk assessment framework, which is something that we have in place for evaluating based on U.S. regulation, as well as the liquidity measures that Sam and I have mentioned around kind of the importance of healthy markets. So no, it's a pretty in-depth process, and as coins pass through the assessment, then we go ahead and list them. So like last night, we've opened up deposits for Nano, and we'll continue to kind of maintain a listing addition going forward. So you can see us kind of increasing the number of coins, but with that comes the scrutiny as we go down the market caps.
Sam, what do you think? You've got a few on here that trade in pretty tiny volumes. I know you just added Tomo on there.
Right.
I think the long tail effect in your chart here of open interest by market is even more pronounced than it is on US. What's the advantage of having some of these markets, and not only for the asset itself, but for a derivative built on the asset? What's the advantage that you see in that?
So I think I'll give sort of 3 answers to that. The first is, we don't always know what's going to trade a lot before we list the market. And so some of this is, I don't know, let's list it and see if it's big. But, obviously to some extent we can guess. To give sort of a second answer, I think this is a little bit of a subtle point. I don't know how important it is, but I think it's worth something. It's a bit different launching a derivatives market versus a spot market, in that the derivatives market is sort of by definition bidirectional. And so when you sort of list the spot market, you're in this awkward stance a little bit of like rooting for the coin to go up almost, because people can only get long on your platform. And so, your users net make money if the coin goes up and lose money if it goes down.
Yeah, I mean, about that in terms of like, backroom deals with whales, right? You're like, well, we'll list it. If you come in and do some market making on the platform. I assume that kind of conversation, goes on across the board, but I think maybe in a derivatives market, due to what you were just talking about, there is a little bit less of a conflict of interest with the retail trader, for example.
That's right. Like when we list the derivatives market, it could go up, it could go down. People can make money either way. And so, that means that there's a lot less of that. I mean, we don't have any of those conversations that you're talking about. We generally don't even talk to the projects before listing them. It's just sort of like, is this a thing people want to trade? And so, that's one thing, is that we don't see ourselves as having, a duty to support the project in a positive direction necessarily, in a way that I'm not saying you would as a spot exchange, but at least there'd be that tug. And so that makes the threshold a little bit lower. And then the last thing that I'll say is this sort of like, come for the shitcoin, stay for Bitcoin effect, where, there are a lot of traders who, yeah, it's a pretty big effect, which is, some traders that they really want to trade they really want to trade Link or something like that. And, actually our Link contracts had like significant volume for some period of time. They still are, the 10th highest volume contract or something. But it's not the only thing they trade, but they might choose their exchange based on which one has a linked future.
So it's not the other way around. Come for Bitcoin, and then you're like, kind of, oh, well, what is that?
Right. You might think that, and there is some going in both directions. But I think the sort of operative thing here is that there is a real effect of like, holy shit, this platform has this product I really want to trade right now. So I'm going to bother signing up, figuring out how it works, learning the UI, depositing some capital so I can trade it. And now that I've put that effort in, I want to trade some Bitcoin futures. Oh, I'm already on FTX. I already know how it works. I kind of like it. It sort of gets people over the hump.
Yeah,
and so that's, that's the other way that we think about it.
If you will, right? Of, whatever. There are certain things that make a difference on that, and other things that don't. Finding a coin that I want to trade is one of those, even if it's a small number. We'll trade that coin. So, I guess, one more thing on that. I want to ask about your index products a little bit. I want to pull up a slide here that highlights a couple of them. I'm really interested in these, and a couple of conversations I've had leading up to this. People are pretty interested in kind of how you're seeing people use those. And kind of, and one thing, we did get a question in from a listener who was curious about, really asking more about fake volume, but mentioned the ETF report and the continued projections of regulated ETFs in the U.S. And I wonder to what extent, and this kind of dovetails with what Catherine's been talking about a mission of accessibility. You have something here that kind of resembles an ETF. I think the Dragon Index is a China-based crypto projects. The Shitcoin Index is presumably a basket of utterly hopeless crypto projects. It gives you the ability to have that kind of ETF-like instrument to short, go short or long in a balanced strategy. So what? Tell me about how people are using those and what you've seen with those that you've launched them.
Yeah, so I think we've gotten a ton of excitement over them. That sort of outstrips their volume, and I think we're pretty happy with them. Even if and obviously we'd love for them to be a larger fraction of the volume, but I think we're happy with them either way because we think they're important, innovative products. And I think that they're really, really sort of, they've got a ton of different use cases. And just sort of, and we've seen people use all different versions of this. And just to run through some, one is, let's say you're an OTC desk, right? And, you do some OTC trade against a customer where you buy some sort of moderately illiquid, mid-cap coin, right? Maybe you buy, I guess BitTorrent maybe is one of the more liquid ones, but you buy some with BitTorrent, some Bitcoin Gold, something like that. And obviously, eventually, you're going to have to actually, sell that token itself in order to kind of close down that trade. But you can't just send a market order for $500,000 of it. You'll kind of crush the market. So how do you hedge? And one answer is, well, why don't you hedge with the mid-cap futures here? And those are super liquid. They're way, way, way more liquid than, basically any of the coins in them. And so you can sort of immediately get your delta hedge off. So at least you've kind of gotten rid of half of it.
So it's kind of a misleading term in a way, right? You think mid-cap, you think, I don't know, Raytheon or something. But
right, it's mid-cap in the crypto sphere. So that's one answer, is sort of for hedging purposes, where you can get an index which is way more liquid than any of the individuals and gets you off, at least sort of some of your, risk. So that's one thing. Another thing, obviously, is, good news comes out from China, right? Like this happened, and Chinese coins went up a lot, and you want to sort of do a trade on it. You could kind of choose one at random, but you're opening yourself up to a lot of adverse selection of maybe like you don't really know exactly which coins are going to be affected by this. Maybe there's some weird idiosyncrasies in the announcement. You choose the wrong coin, it doesn't move, something like that. What you really want, what you're trying to express is not like Tron. That's the one that's going to do well. What you're trying to express is, in general, these coins will. You want to trade quickly, easily.
That excludes Tron, because that would be the one that I would.
Well, so what we do have is we have the Dragon Index, and then we have Tron futures. And so that's another thing that you can do here is that if you think that like Chinese associated cryptocurrency projects are going to outperform, but you're bearish on Tron, you can get long Dragon against short Tron futures.
Yeah. No, I think it's cool, and I think maybe a question I think for Catherine in terms of your sort of ethos when it comes to and Binance US's ethos when it comes to this stuff. Like this is kind of a softball maybe, but like what are some of the things that are happening in crypto markets here today and in general that you think are likely to make their way over to traditional finance? I mean, and just to set the table a little bit, like I look at the way the large derivatives exchanges have set up, without central clearing, have set up, market structure in order to manage, high volatility, high risk, a lot of leverage. Those engines are sort of constantly being refined, and we can talk a little bit about some of the hiccups in a minute. But I wonder if, as you look at that and look at some of the innovations in market structure that are happening, what do you see here that has the potential to over some period of time gain adoption in traditional finance?
Yeah, that's an interesting way of seeing it, because I oftentimes think we're pulling too much from traditional finance and putting it onto crypto. So what is the reverse, or what is the impact that we'll see on traditional finance? So I like thinking about that. Thank you for the question. But the elements, I think we've already seen from some of the equity houses or equity trading, retail trading platforms, is that reduction of fees. Recognizing that there's efficiencies in these platforms that they need to be transferring to their customers now. So kind of the reduction of these, what used to be kind of fat margins, coming down, given the increasing automation and, streamlined technology that we can be providing, no longer having to really pay per voice that's going to be communicating. So in elements that, but on the, the future side, the U.S. just operates in such a different way. Given the licensing requirement from CFTC, the clearinghouses, FCMs, the breakdown in the United States is significantly different of a landscape than we can have with like the global futures markets that we've seen from FTX, BitMEX, and Binance. So I think there's, as much as I'd love to see the crossover happen quicker, there's still quite an element of infrastructure here in the United States that requires its own custom build out.
It feels like there are just I think a lot of people use the analogy of like exposure to risk, and where and so I hear a lot of people talk about this in terms of maybe the United States not being the first place to adopt crypto assets, en masse. And the reason for that being that, there's a fair amount of risk you can kind of get exposure to here if you want to. You can go on E-Trade.
Yeah. And the other components of like the native use case of cryptocurrencies is felt so much more outside of the United States. I mean, to go across from California to Nevada, you don't have to exchange your currency into a highly volatile cross pair. But the moment you go from Vietnam to Singapore, your spreads are ridiculous and not necessarily accessible. So I think it's just the elements of which crypto provides from a use case perspective are just innately felt so much more from international perspectives. And so that's like one element that you can factor in.
Let's talk about taking on risk as a use case, right? And I think a lot of times people want to separate use and speculation, and I think that's a fair distinction to make in some cases. But broadly speaking, speculation is you're using something.
Yeah, I mean, and your risk appetite breakdown. I mean, the risk appetite of a country that's able to leapfrog years of financial development through the adoption of a new technology, you know, bullish, you know, all in. Whereas you're like, oh well, my ETF.
We are in Las Vegas, right?
Yeah, my ETFs are. Well, it's funny. I've actually never been to Las Vegas, but I've been to Macau enough. So yeah. I, you know, learn to play blackjack on a Macau floor is a little different than
the analogy I think is there, right? Macau is I mean, and this is not a new idea, but Macau is or was experiencing something that that the United States experienced in the post-war boom. You know? And that's what you were saying. That comes with that.
Yeah, it just comes with that attitude of there's significant reason for why the speculation and the upside seem so much more tangible than in the United States, where you've got a robust equities market right now, as well as pretty stable. I mean, we think about custody. I think it's fascinating that we see such great legacy names coming into the space in crypto, because no one would be keeping their 401ks at brand new shops that opened up a month ago. I mean, you're going to be leaving, or you're going to be placing some of your longer standing funds at these very well established shops. And so I think that's just the risk element of the United States is completely, it's interesting. It's both different and similar in the aspect of there is a lot of speculative money in the United States, and there are an insane speculative appetite outside of the U.S. So
yeah. I guess I sort of and U.S. being U.S. individuals like myself being excluded from most of the platforms we're talking about. This may not really be applicable, but I sort of look at what innovators are doing as maybe and Bitcoin itself really, like for me, venture capital is not really an asset category I can participate in. But if I just buy and hold Bitcoin, it's kind of like a venture bet. And so I think you get that sort of opening up of markets that otherwise people would be, or sort of asset categories that or asset category and that analogies that otherwise
absolutely
excluded from.
Yeah, absolutely.
Sort of, I guess thinking then maybe to kind of leap forward a little further, thinking about ETFs and access to those, and kind of fake trading, and we've had a couple of questions come in from listeners about the wash trading and the fake volumes, and et cetera. And I think where it really, I mean, it's one thing to just sort of pump up the volume, if you will, and try to sort of gather market share by doing that. But I think, another thing that comes into play is the kind of manipulability, if that's even a word, and the, in a thinly traded market, the ability to go in and really push the price around. And I just put up the chart here that we put together at CoinDesk, looking at sort of minute by minute the flash crash event that occurred in May 17. And this was where, it's impossible to say whether this was manipulation or not, but what happened was a very large outsized ask order got placed well below the market price in the wee hours of the morning on out of the three exchanges that form the BitMEX price index. This is the most thinly traded of the three, Bitstamp. And the result was the price pushed down by a good $1,500 or so, the Bitcoin price on this one market, and a cascading effect of auto liquidations on BitMEX. And long story short, it looks like about 1.5 million in sort of potential sale revenue sacrifice in the Bitcoin market on Bitstamp triggered about a few $100 million of activity on BitMEX. So somebody who, if this was manipulation, somebody who was positioned to take advantage of that activity on BitMEX could have reached quite a return here. And I think that's, that event is something people have picked apart and looked at since then. And we've had at least one other event that I'm aware of that was similar to it in the Ethereum market. And I wonder kind of, what you guys think about, both, I think as a spot market at Binance US, making sure that the market can be kind of surveilled and that manipulative activity can be excluded. And then on the FTX side, how do you think about sort of managing indexes and making sure that the data that you're getting in can't be manipulated in order to affect the outcome of a trade on your market? So Sam, I guess I'll hand that one to you, kind of to kick off, if you will.
Yeah. So, I think the first thing that I'd say, I'll give a few answers. The first is the sort of literal answer is we cap the divergence of any member of the index from the median at, I think it's 30 bips or something like that. And we have a lot of elements of our index, way more than most do. So, most sort of Bitcoin futures have something like 3 elements of the index. We have something like 12 across like 6 different exchanges. And the reason we do that is it means that we're using some less liquid markets, which is a cost, but the sort of noise from those being 5 bips out of line really gets drowned out when there's 12 of those. That's like a fraction of a bip effect. But when a few, one or a couple exchanges go haywire, it's really nice to have enough that the vast majority are still showing a sort of reasonable price. And so, if you sort of throw out the outliers, you still get, roughly the right index price. So that's sort of the first answer to the question. And then you say, all right, what happens when the exchanges goes to 0? Well, capped at 30 bip divergence, it's, a tenth of the index or whatever. You're talking about a few basis point impact on the index for an 80% move on a unfair move on an exchange. Yeah. So that's sort of the first answer to what we do.
Diversifying data sources in those indices is really, I guess maybe I'm inviting you to kind of bash your competition here, but why do you think, why would somebody put a $1 billion daily market on an exchange, on an index that's composed of three spot markets in my life?
Yeah, I don't have a better answer than just laziness and not wanting to change things from how they were 4 years ago. There might be one, but I don't have one.
The effect of why fees are high now and how they might come down in the future.
Yeah, it's just sort of that's how things were back when there were only a few exchanges and things haven't changed. I think is the basic answer. So that's one part of it is, and I think like a really crucial part of this is you asked how do we tell if data is bad? You can't. Like cryptocurrency exchanges are not at a point where you can get a data feed from one and tell for sure if it's bad or good. They just randomly publish data that's wrong in exactly the same format as they publish good data. And crypto is volatile enough, things can legitimately move 15% in a minute. So you can't even say, was there a big move? Oh, that's got to be fake, because sometimes moves happen. So, you're just sort of fucked on that. And you're left with sort of nothing other than saying, I don't know, there's a lot of exchanges, like, has everything moved? If so, it's a real move. Maybe you don't like it, but that seems to be what the market's doing. You can trade $1 billion against it, so I guess it's real. And
do you guys have thoughts about that in terms of, the data that you produce and making sure that things that are happening there are real, and also, sort of monitoring participation of, traders on the platform? This may be, at a small stage, it's probably less of an acute problem, but, something you're probably thinking about for the future. What are your thoughts on that at this point?
Yeah, it's kind of interesting because I almost view it, we're even more elementary than people expect. Every single user that goes through our process goes through in-depth KYC and AML. So we know exactly who's trading on our platform. We also have on-chain analytics monitoring all the behaviors that are taking place on our, wallet addresses and going back and forth, seeing the behavior of our trading that's taking place. And given the size of us right now, it's pretty easy to see what's happening in the markets if we're only trading about $5 a day. So, or 5 to 25 is still a really reasonable size for us to be able to see who and what is happening with the full knowledge of knowing all the customers that are on our platform are ones that have been vetted through our KYC. We have the different tiers of verification. So you've got basic, verified, and fiat, but with that, it just comes a great awareness of kind of who's transacting on our platform. And on-chain analytics, like you've seen, there's probably 4 vendors out there now that provide really clear sets and risk parameters that we're able to make sure we're not, welcoming behavior that's going to be toxic.
Yeah. Well, I want to kind of actually back up from that a little bit and kind of go back to something we were talking about before. Well, we've got a few minutes left because this is something I really wanted to hear from you guys. Is kind of what is the, and I think both of you probably have a good perspective on this. Catherine, giving your background in Forex and then with Ripple before this, and Sam, given the fact that Alameda is actually making markets on some of the venues that FTX is providing. So the question I want to ask is what do you do to attract institutional investors and potential market makers onto the market? The kind of thing that, as you were saying earlier, Sam, liquidity is really the ultimate measure of kind of quality and progress. How do you bring the large participants who can provide that kind of liquidity?
Yeah, I mean, one of the elements that we've kind of taken advantage of being a kind of a new liquidity source for others is being able to integrate into the existing technologies that are really laser focused on those audiences without having to take that on ourselves. So we have, several partners already in the space that are really focused on being able to be the institutional offering for folks to access these markets, and they are able to plug in directly to our liquidity. So sometimes you don't have to do the hard work yourself. You just partner with people that are laser focused on it. So we've got a couple of names that we've already built that out, the functionality, so people can leverage our liquidity there.
Sam, sort of thoughts on that from both sides of the table?
Yeah, so I will say that, Alameda is one of the most demanding and rewarding clients that you can take on as an exchange. And, I sort of feel the pain on both sides now. And I think ultimately taking on someone like Alameda as a liquidity provider can be a really, really good experience for an exchange, both because, taking on a liquidity provider gets you liquidity, which is really crucial for an exchange. But I think it also involves, getting a lot of requests for features that make the platform better.
What are some of those features? Like, what are you
right.
really going to be looking for that an exchange should provide to bring in a liquidity provider?
So there's a ton of stress testing of various things, and just to sort of go through some, and I do really want to emphasize here that there isn't a silver bullet, that it really is like there are 20 things, and you sort of have to get them all at least sort of right. And so to go through these, first of all, limits, like you have to have a way for institutions to have high enough limits to operate, right? You can't have a limit on deposits and withdrawals of $10,000 a day, or it's impossible to do arbitrage on your exchange. And so what that means is, let's say people come buying a ton of, EOS. That's all they're doing all day is buying EOS on your platform. Well, all liquidity providers are going to be doing all day is moving a ton of EOS to your platform to provide liquidity and then moving out the assets they're selling it for. If there's a $10,000 withdrawal limit, they can only trade $10,000 a day before they're just like out of EOS to sell and out of the ability to bring the tether or dollars or whatever out of the platform. So, you really need high withdrawal limits for high volume accounts. You need high rate limits, obviously. And this really, if you want people providing liquidity, this is a huge difference, right? You can imagine a taker who just sends an order when they want to trade. If you're making, you send, an order a second. It doesn't matter if no one's there trading. The whole point is that a liquidity provider is there providing liquidity ready for someone to come trade whenever that happens.
Right.
So you're getting high order usage 24/7, whether or not there's high volume, high withdrawal limits. You're getting, withdrawal times really matter. Like you have to be able to process withdrawals within, an hour or so. What else really matters here? Like fiat support, like if you're going to have it, making sure it works well, making sure that if you have, risk limits or risk checks or things like that they don't just like always flag every institutional account every 20 minutes. And then making sure that your products really do what they're supposed to do. And there's a lot of cases where, especially for more complex products for derivatives, they'll just have really, really bad behavior in some cases if you don't think the product design out well. And, did you think what happens if there's a fork? Am I going to do something reasonable in this futures contract, right? Did you think exactly how does this expire and what data sources am I using, for the expiration of it? Did you think about what happens if one of the exchanges, which is part of the index, decides to block deposits or withdrawals of the coin and goes to a massive premium or discount? There's just a ton of things. Did you think about liquidity death spirals and like what you can do to prevent that? There's a ton of things that you have to think through, which you really care about if you're asking a liquidity provider to put on a $10 million position providing to customer flow in some derivatives product. And you're like, oh yeah, and then also like once every 3 months, we're just going to liquidate you because there's a breakdown of the risk engine. Like you're not going to get liquidity that way. And so, there's a ton of different ways. And this is only going through some of them. There's tons of API requests, API rate limits. To give one example of a thing that like half of all exchanges screw up, I think this is super instructive. Almost all exchanges have an API. Almost all exchanges have a way to ask the API something like, what are my open orders, for instance, right? But on a lot of exchanges, there's an API rate limit of 10 queries a second or something like that, and it's a separate. And when you query what are my open orders, you have to specify a market. So like, what are my open orders on Bitcoin Tether? Right. Well, the problem is if your exchange has 100 markets, and you can only get them one at a time, it takes you 10 seconds of rate limits just to get your open orders across the platform. You can't trade if you're doing that. And this is the thing that half of all exchanges screw up. And when Alameda is trying to onboard to a place, this is one of the first things we look at because we just know they probably screwed it up and that it's going to be close to a non-starter.
Crypto needs to grow up. Like
right.
To grow up. Everybody's like, win institutions, and let's grow up a little, and then maybe we'll be ready when they actually, when somebody in a large institution actually does take interest.
Yeah,
right,
having seen like how institutions expect these markets to behave, having been on the inside of traditional markets, like there's a lot more that needs to be done. And so I think Sam and I at least can see things through the eyes of traditional folks and understand like if we do not have adequate limits to accommodate for the scale and scope that they really do want to be trading in these markets, we've got exactly time to grow up.
Right. No, you may not have the keys to the car.
I use that analogy all the time. I'm like, we're still in the babysitter phase. Like,
yeah.
This has been great. We're like over time, but I want to give you guys just a minute or two to wrap up, if you would, and if there's anything you want to say or talk about that we didn't really get into. I don't know, Catherine, you want to go first?
Sure. I mean, check us out, Binance.us. Sign up, look at it, give us your feedback on the platform itself. I'm keen to all of the feedback. It's the only way that we can make the product grow to the expectations that you really already have. So we listen to, everyone is a key component to the platform. We just announced that Black Friday following Thanksgiving, we'll have 75% off of trading fees for folks that hold 5 BNB or more. So keep alert at Binance America on Twitter, and then or at CryptoColia on Twitter, and we produce our announcements and keep you in the loop on new coin listings and new products and discounted fees. So that's it.
Great. Sam? Anything to add?
Yeah. Nothing much. Again, like we'd really love to have you trade on FTX. We'd really love to have you give it a shot, create an account, see how it goes. Give us your feedback. We're active SBF_Alameda on Twitter. You can find we have a Telegram group. We've got WeChat groups in Chinese. You can always email us support@ftx.com. We're constantly growing and adding more features, and we'd love to have you. We want this to be a platform that works for everyone, and so we'd love you to be one of those people.
Great. Well, Catherine, Sam, thanks both of you for joining us today. Really appreciate it. It was a fun conversation, and hope we can do this again sometime. Again, this is Galen Moore, and you're listening to the second in CoinDesk Research's webinar series. Anybody listening here, anybody who signed up, you'll get an email with the recording of the entire presentation. And I hope you will join us for the next one. We should be putting something together on the topic of crypto lending for the month of December, so look out for an announcement about that in the not too distant future.